So, mortgage rates just hit 3.69% here in Canada for the first time since 2022. You've probably seen the headlines, TikToks, YouTube videos, all shouting rates are back. And on the surface, that sounds amazing, right? But here's the truth. While this sudden drop could be a massive trap for unprepared buyers chasing promos, it could also be a massive opportunity if you're sitting at a higher rate. Now, let me explain. I'm Justin Chose and I'm a mortgage expert, and I want to break down the two realities in today's mortgage market. On the one side, you've got banks dangling flashy 3.69% specials that come with strings attached. And on the other side, you've got homeowners locked into 4.8, 5%, even 6% mortgages who could actually use these lower rates to save money, real money, right now. Let's start with the opportunity. If you're paying 4.8% or higher on your mortgage, you need to ask yourself one simple question. Am I leaving money on the table? Because refinancing into something below 4% could mean hundreds of dollars back in your pocket every single month. That's money that you could use to pay down high interest credit cards, lines of credit, or ease the financial pressure in your household. And the same goes for people that are coming up for renewal. Don't just sign the offer your bank sends you. That's the trap that most Canadians fall into. Most people assume that the bank is giving them the best deal, when the reality is they're just sending you the first piece of paper and hoping that you'll just say yes and sign it without asking any questions. Right now, if you're at renewal or you've got unsecured debt piling up at 20 or 19% interest rate, this is your chance to consolidate, refinance, and reset your financial plan while rates are temporarily lower. But here's the flip side. Not every 3.69% mortgage is created equal. A lot of these promos are incredibly restrictive. They don't allow for pre-approvals. You need to close within 30 days, and often you have to move your entire banking relationship over to that bank. They're short-term bait designed to lock you in. So while some Canadians can use these lower rates to save money, others could walk into a contract that could cost them more down the line. That's why strategy is everything. The opportunity here is real. If you're paying 4.8% or higher, refinancing could be the smartest financial move you can make this year. But if you're a buyer chasing a promo without reading the fine print, this could turn into one of the most expensive mistakes of your life. In this video, I'm going to walk through both sides for you. How these promos are being used as a bait by the bank, and how to avoid getting trapped at renewal, and how you can actually use today's rates to save money, pay off debt, and get ahead if you do it strategically. So let's dive in. All right, let's dig deeper into what's really happening here. Because while the headlines are hyping 3.69% mortgage rates are back, there are really two stories playing out. For some people, this is a trap. For others, it's one of the biggest opportunities that we've had in years. And the difference comes down to one thing: strategy. Let's start with the trap side, because this is where I see a lot of Canadians rushing in blindly. These 3.69% promos are not designed to help you. They're designed to help the banks hit their year-end targets before October 31st. They're bait, and like any bait, they come with hooks. Here's what these hooks look like. No pre-approvals or pre-qualifications. You have to close within 30 days. You often need to move all of your banking over to that bank. And in many cases, you're locked into restrictive contracts with big penalties if you need to make any changes. On paper, the rates look amazing, but in reality, these mortgages are often inflexible and they could cost you thousands if life changes or when renewal time comes. And renewal is where the real danger lies. We've got 60% of all Canadian mortgages renewing in 2026, millions of households, and the average increase in payment is expected to be around $513 per month, and that's huge. So imagine this: you've grabbed the shiny 3.69% promo rate today, but 3 years from now, you're renewing at 5.5%. Suddenly, your payment jumps by $600 or $700 a month. That's the trap. That's the part nobody in the headlines is talking about, and that's why strategy matters. I had clients come to me recently thrilled about a 3.9% mortgage. We ran the math, and if rates go back up at renewal, their payment increase would be $600 a month. All of a sudden, that amazing deal didn't feel so amazing. So, yes, chasing the lowest rate without a plan is a mistake. But here's the other side of the coin, and this is where the opportunity comes in. If you're sitting at a mortgage with a 4.8%, 5%, or even 6%, this rate drop could be a lifeline that you've been waiting for. Because refinancing down to something below 4% could save you hundreds of dollars per month. That's money that you can use to pay down high interest credit cards at 19 or 20%, consolidate lines of credit, or free up cash to handle other rising costs. Now let's think about it. Would you rather be paying 4.8% on your mortgage while juggling credit card balances at 20%, or restructure, drop the mortgage rate by a full point, and use the savings to wipe out the debts that's really eating you alive? That's the kind of strategy that separates the people who survive these cycles from the people who get buried in them. And here's the key. It's not just about chasing the lowest number. It's about understanding the terms, the penalties, and how the product fits your life. Because the reality is, not every 3.69% mortgage is created equal. Some of them are short-term promos with strings that lock you into whatever rate the bank offers next. Some of them don't give you the flexibility to refinance or move. And if you're not careful, you could trade today's short-term savings for tomorrow's long-term pain. So let's talk about the three groups of people we're seeing right now. Number one, we're seeing rate chasers. These are the people who are seeing the 3.69% and jump without asking any questions. They're focused only on monthly payments today because they're ignoring penalties, flexibility, and renewal strategy. And when their payments jump in a few years, they're the ones that are going to be panicking. We also have the waiters. These are the people holding out for 3% before they make a move. I've had clients saying this since 2019. Meanwhile, they've missed years of equity growth. They're still paying high rents and they've watched home prices climb. The perfect time doesn't exist. The cost of waiting is often higher than the cost of acting strategically today. And number three, we have the strategic borrowers. This is where you want to be. These are the people asking, what does this mortgage allow me to do? How flexible is it? What happens at renewal? How can I use the lower rate to restructure my finances, pay off debt, and be prepared for the 2026 renewal wave? And let me be clear, the strategic borrower might not choose the absolute lowest rate. They may pay 0.25% more for a product with better prepayment options and lower penalties because that flexibility could save them $20,000 down the road. That's the mindset you want. So here's the opportunity. If you're at 4.8% or higher, you've got debt at double-digit interest rates, or if you're coming up for renewal, now is the time to run the numbers. You might be leaving serious money on the table if you don't. But here's the warning. If you're just chasing the headline number without looking at the terms, you could be locking yourself into the trap. And that could cost you more in the long run. The difference between saving and getting stuck comes down to one thing, whether you treat your mortgage as a rate or as a strategy. So let's bring this all together. Yes, 3.69% mortgage rates are back. And yes, that headline gets people excited. But the real question is, what does this mean for you? Because here's the truth. This isn't one size fits all situation. For some people, chasing these promos blindly could be the mistake that costs them thousands at renewal. But for others, especially those sitting on rates at 4.8% or carrying high interest debt, this could be a golden opportunity to save money and reset their financial plan. So here's how I see it. If you're paying 5 or 6% on your mortgage right now, locking in below 4% could literally put hundreds of dollars back into your pocket every month. That's real cash flow that you could use. Consolidate those credit cards sitting at 19%, pay down lines of credit at 10%, or simply create breathing room in your monthly budget. This is how smart homeowners use rate drops, not just to celebrate the smaller mortgage payments, but to restructure their entire financial picture. Now, if you're coming up for renewal, this is also your chance to make a move. The banks will happily send you an offer and hope you sign it without any question. But here's where many of the Canadians leave money on the table. You have to shop and you have to negotiate and you have to look beyond just the rate. Ask yourself, what are the terms? What are the penalties? What are the prepayment privileges? And what happens when life changes happen? Because it always does. That's the trap side of the equation. Banks know that people renew out of convenience and that they use promos to lure you in short term, only to hit you with higher interest rates later. That's why understanding the fine print is just as important as looking at the numbers. But here's the part I don't want you to miss, which is the opportunity. If you're sitting at 4.8% or higher, or if you have debt dragging you down, don't ignore this moment. Rates this low may not stick around. Once bank hit those October targets, these promos disappear and rates will likely settle higher. So the question is, are you going to let this window pass you by, or are you going to use it to put yourself in a stronger position? Because in 2026, when 60% of mortgages renew, this is going to be a massive wave of payment shocks. The people who just chase the lowest rate today will be the ones panicking, but the people who took advantage of today's window strategically by refinancing, consolidating, and planning will be the ones sleeping at night knowing that they're prepared. And that's the choice you have right now. So here's my advice. Don't just celebrate 3.69%. Ask yourself, what does this mean for me? If you're at a higher rate, you could be leaving serious money on the table. If you've got debt, this could be the chance to clean it up. And if you're renewing, this is your opportunity to negotiate, not just sign what's handed to you. At the end of the day, the trap isn't the rate itself. The trap is thinking the rate is the whole story. The opportunity is using today's market to make smarter, more strategic moves. And if you want help figuring out which side you're on, that's where I come in. I've dropped a link below in the description where you can set up a time in my calendar and we can look at everything. Let's look at your current rate, your debts, your goals, and see if there's money you're leaving on the table, or if you need a strategy to protect yourself at renewal, because this moment is short-lived. You can either be the person who panics when the renewal comes up in 2026, or the person who looks back and says, I used rates below 4% as a window to put myself ahead. And I know which side that I want you on.